Okay, fam, we are going to be talking about the rate cuts and the FOMC meeting with the Feds on Monday and Tuesday of this week. So we're going to be getting a 25 base point rate cut in the stock market this week. I'm going to go over some details here and explain to you guys why it's good, but also why there could be a little bit of a tricky hiccup going on in the market. Stock prices could pull back quite a bit Monday morning and then run the rest of the week. Let's go over some of the facts we know because this is an exciting time. We're finally getting rate cuts, but how is it going to affect the market? We already know it's heavily manipulated. So let me read verbatim what's going on in the market and why there could be a very slight pullback. Markets expect the Federal Open Market Committee, FOMC, to most likely cut interest rates by 0.25% on September 18th. That's according to the CME Federal Watch tool, which tracks implicit forecast of fixed income markets. Previously, a larger rate cut was a strong possibility, but the chance of that has receded to around 10% currently after the recent jobs and inflation data. There is a 99% chance of a rate cut in September. FOMC policymakers have also clearly signaled that lower interest rates should be expected in the near future. So I expect we're probably going to have another rate cut or two by the end of the year. Headline consumer price index inflation was reported at 2.5% for the 12 months to August. Core inflation, which removes food and energy price changes, is running slightly higher at 3.2% annual rate. Personal consumption expenditure inflation, a metric is the FOMC typically refers to as running 2.5% annual rate to July of 2024 and 2.6% excluding food and energy. Those figures will be updated for August on September 27th. To the extent inflation is running over 2% currently within the CPI, that's mainly due to shelter costs. This category is rising at a 5.2% annual rate as of August and carries a high weight within the CPI series because shelter is a large part of most household budgets. Inflation is now much less of a concern than in recent years, but is still not at the FOMC's 2% annual target. This is perhaps prompting a more measured approach to the potential interest rate cuts. FOMC want to eliminate the risk of inflation returning, even though that risk is generally considered to be declining and relatively close to target. If inflation were at 2% today, then FOMC might be more aggressive in bringing lower rates, since the primary reason for hiking rates since 2021 was to fight elevated inflation. So I'm going to share with you guys right there on the screen something I shared with my Discord. CPI inflation facts. The average inflation percentage over the last 16 years is 3.2%. Right now we're at 2.5. In 1980, we hit a peak of 14%. In 2008, during the crash, we hit 4%. In 2022, we hit pandemic high of 9.1%. However, pre-pandemic in 2019, we had 1.8%. So you can see how in 2023, we have 4.1%. In 2024, we've averaged 3.2%. And recently, over the last month, we're at 2.5%. So you can see that we're almost relatively back to 2019 pre-pandemic level. So really, inflation is, like Tom Lee said, falling like a rock. Unemployment ticked down to 4.2% and non-farm payrolls grew 142,000. Nonetheless, unemployment has risen gradually for much of 2024, but August jobs offered a degree of reassurance that jobs market is not deteriorating as fast as some forecasts may fear that it might. If the jobs market were to weaken further or faster, then the FOMC may be prompted to cut rates more aggressively. That being said, there are two sides to this analysis. On the one hand, unemployment is edging up gradually from a very low level. As such, this return to a more normal unemployment rate may not be a concern. However, historically, it hasn't taken much of a step up in unemployment to trigger a recession. Indicators such as the SOM rule, which looks for a 0.5% rise in normalized unemployment within a 12-month window to call for a recession, suggest that we could be at risk of a recession from the absolute rise in unemployment in 2024 relative to the 2023 already. Nonetheless, the inflation not completely at the FOMC's target and the jobs market cooling, but suggesting a less severe decline so far, the FOMC may avoid larger interest rate cuts, at least for the September meeting. However, fixed income market assets, the larger interest rate cut of perhaps 0.5% is quite possible when the FOMC meets in November or December. That could be because markets project further rises in unemployment. There are 3 more employment situation reports to come in 2024. These are on October 4th, November 1st, and December 6th. If these show further deterioration in the jobs market, and especially if inflation moves closer to 2% over the same period, then the FOMC may lean towards more aggressive rate cuts. I know this can sound confusing, talking about inflation rates, the FOMC meetings, cutting these interest rates, inflation, CPI data, PMI data. If this is confusing and you're having trouble in the stock market, I would love to help you guys out. I offer a full training course, Discord, and one-on-one coaching, although spots are limited because I can't take everyone. If you're serious and committed to your financial freedom and financial health that you ultimately deserve, I would love to help you. You guys can sign up at any time at investwithcorey.com right there on the screen, or the link will be in the information box below. I cover everything on how to understand technicals, fundamentals, charting, trading, candlesticks, CPI data, PMI data, understanding the sentiment, the psychology of the market. I go over everything. I would love to help you, but like I said, spots are limited, and this is a very serious mentorship. So if you would like to take control of your financial freedom, I would love to help you. My students that sign up for my Discord are all up 5 to 15% their first month. Most are between 10 and 15%, and their second month, 20 to 25%. I'm showing you guys right now on the screen all of the Discord students that are up exponentially over the last 2 to 3 months. Even my new students with small accounts of only $10,000 are up $2,000 and $3,000 in their first month. If you guys would like to learn how to do this the right way, I would love to help you. I'm driven every single day to help people just like you achieve their financial goals. This is what took me from 25,000 all the way to 2.2 million in 6.5 years. So I want to talk more about the rate cuts here, the key takeaways. The Federal Reserve is widely expected to cut its benchmark interest rate when it meets Wednesday. The rate influences borrowing costs for mortgages, credit cards, car loans, and been kept at a 2-decade high for more than a year to discourage spending and subdue inflation. With inflation having fallen close to pre-pandemic levels and the job market weakening, the Fed is at a turning point preparing to cut rates for the first time in more than 4 years. Although Fed officials have signaled rate cuts are all but inevitable, the size of the first cut is up in the air. This is the first rate cut since 2020 this coming week, a move that consumers, businesses, and investors alike have been eagerly awaiting. So this is something that is very important because we're expecting them to cut 0.25%. If they end up cutting 0.5%, the market is going to fly. If they cut the 0.25%, the market's still going to move pretty good. If we don't get a rate cut, things are going to get really weird. But the percentage of that happening is less than 1%. What they say, the verbiage, what they actually say to us during the rate cut matters just as much, if not more than the rate cut itself, because we're already pricing in a 0.25% rate cut. So if they say we're cutting the rates by 0.25%, but it's highly unlikely we're going to cut rates before January, the stock market's going to have a little bit of a problem going through the rest of this year, especially in September, October, and November. It'll probably be fine after elections and going in December. But if they say there's not likely going to be another rate cut, or it's highly unlikely or slightly unlikely or anything that's unlikely, the keywords matter in the stock market, believe me. Anything that says probably not or unlikely, highly unlikely, slightly unlikely, we're not sure, anything that's not reassuring or negative, both very bad. If they say we're cutting rates by 0.25% and we see the likelihood that there's going to be another rate cut, we don't know what that rate cut's going to be like, but they do see that there's likely to be another rate cut before the end of the year. That's good news. If they say something that's good, like might, could, should, and likely, or most likely, things like that, while they're cutting the rates this week, the stock market's going to boom up nicely. There's going to be a nice little run. It really depends on what they say. They could be cutting the rates by 0.50%, which is 0.50, double what we actually expect. But if they say there's not going to be rate cuts for at least another year, that's not going to be very good. You see, what they say really truly matters. And we know this is a game of manipulation. to the most part. So I don't expect the greatest news during the rate cuts, but if they say that we're going to get another rate cut by the end of the year and they cut by 0.25% like they said they would, we're in good shape. If they're going to cut by 0.50%, which is 0.50, and there's decent, like neutral to positive news for another rate cut going forward by the end of the year, then the stock market could fly immensely. Just be prepared for a slight pullback and some fear on Monday and Tuesday. And after the Fed speak about the rate cut, as long as it's pretty decent or better, we're going to have a nice run going to the next week or maybe next couple of weeks. This is a pivotal moment in the stock market. We've been waiting months, years for this rate cut to happen. Let's just hope the Feds can cut by a decent amount, but not only that they can actually have some good report and good assessment and guidance on the future rate cuts before the end of the year to go along with that rate cut. Because ultimately, right now, we're on the cusp of a much better economy and market than we've had for the past 4 years. And ultimately, that makes the situation for us as investors and to be able to live and invest our money and make profits a much easier and better experience overall. So this coming week, all the cards are on the table and everything's out in the open. It's just a matter of, is it going to be good? Is it going to be bad? Or is it going to be neutral? But at the end of the day, if it's good, we are going to have a really awesome time in the market for the next couple of weeks. Rate cuts are on the horizon. It's just a matter of, are the Feds going to deliver some good guidance and good projections going forward along with that rate cut? Guys, if you really want to get better in the stock market, I would love to help you. I offer full training course, Discord, one-on-one coaching, limited spots. If you guys are dedicated, I'm dedicated to help you. You can sign up at investwithcorey.com right there on the screen. The link is also in the information box below. I will see you guys on the next video. You guys can click it right over there. We'll see you guys in the next one. Take care of yourselves.